Welcome to the VeriDAO channel. I am Lisa Davis, and I am a VeriDAO volunteer. And today we're going to have Reggie Middleton join us and talk about the banking collapse. So we'll be right back right after this. Welcome to the channel, Reggie. Good to have you here.
Thank you. Always good.
Yeah, great to have you. Trey, thanks for joining me too. I really enjoy having you on the VeriDAO with me, and enjoy your leadership in the DAO as well.
Well, thank you, Lisa. It's a pleasure to be here today.
Yeah, I wanted to get some background on what's going on in the market right now. I think everyone is just in a full panic, trying to get as much information as we can. There seem to be a lot of everyone's got an opinion, as they say. And I wanted to go back in history a little bit and get some information from somebody that's knowledgeable. So Reggie, we all look to you. You seem to have your head on a swivel and know what's going on in the markets. We look back on, you created a term about a year ago, I guess. You and Trey did an interview and talked about a term, or created a term called Masada. And I wanted to play this for everyone. Just a second.
That is the same chair.
It is the same chair.
Is that the same shirt too? Oh my God. I do have more than one shirt and more than one chair. I have at least two. So
we might have to, yeah, we'll check other videos.
I think you got that shirt is polka dotted or checkered in the previous video.
Okay.
Yeah.
Well, if not, we'll put polka dots on there so it doesn't look like I had the same thing on.
We'll zoom in. Yeah. So this is the term Masada. Money is a depreciating asset, and so I wanted to give everybody just kind of a little bit of this to give some background.
I explain, wealth can never, ever, at least in this particular country, be attained by amassing large amounts of money. Money in particular, is the most disrespected asset in this country. It's taxed at the absolute highest rate. It's the absolute lowest return. And it's treated the worst. So let's take right now. If you suppose you had $100 million dropped in your lap.
I think everybody would love to have $100 million dropped in their lap right now.
Wouldn't be a bad day.
Wouldn't be a bad day. So you had an epic call in 2007. You shorted the Bear Stearns, Lehman Brothers, and what we now know as the Great Recession. Do you see similarities from what's happening now?
Yeah, you have what I call ALM, or what the industry calls ALM. That's an asset liability mismatch. Basically, the bank's business model is just to move money around. I gave my daughter a ride to school today, and we were discussing patents and economics and finance, because in her economics class in her senior year in high school, she is representing the side of the debate that represents patents and whether they're economically viable. So we went through patents and then the banks and Silicon Valley Bank and JP Morgan, etc. I'll gladly discuss our conversation, but more to the point, I was explaining to her how the banks were failing and how the media, the mainstream media, and I'm trying to be politically correct so I don't get myself in trouble. Certain members of the bureaucracy, certain politicians and prosecutors, etc., were trying to make this a crypto thing. The crypto contagion infected the banks, caused the banks to fail. Quite to the contrary, it was the opposite. The large crypto companies who are clients of the banks have been weakened because the banks collapsed and took with it the crypto companies' deposits. The reason why they failed was asset liability mismatch, where the liability is the IOU that they gave the depositors. So Trey, Super Crypto Company Trey Exchange, TE, right? STE, right? Not STD, STE, Super Trade Exchange.
Right.
Gives Bank A $100 million. Bank A then takes that $100 million and promptly invests it to try and make a large return. And they promise Trey 75 basis points. So they're going to be close to nothing, but they're going to try and make, 3, 4, 5, 6% if they can. Okay. That's done on the assumption that Trey doesn't want his money back, or at least all of it back anytime soon. So they invest in long-term bonds and medium-term bonds and short-term bonds. So 30-year treasuries, 20-year, 10-year, 9-month, 3 months, etc. Okay. Now, interest rates are being raised by the Fed to allegedly, quell inflation. And of course, that's another conversation about how well they can do that because of structural versus monetary interest rate, pressures. And when you raise interest rates, the prices of bonds fall because, and I understand that a lot of you may know this, but I'm going to walk through it. If Trey had another $100 million and Trey lent that $1 million to me as a bond, a note, at 5 basis points, that's 1/20%. Okay, that's what 3-month treasuries were trading at in the 1st of January 2022, by the way. And then rates went up to 4.7%, which is what that same 3-month bond was trading at the last day of 2022. The price of the 3-month treasury bill will go down. The reason is, if you had a choice of making 5 basis points or 1/20%, or 4.72%, which would you pick? You had to pick out of those two. Everything else remaining the same.
I'll take the 400 basis points, please.
Yeah, the 4.
Right. So everybody wants to get paid more. So they do that. But since everybody wants the one that pays 4.72%, a lot of people are selling off the one that pays 5 basis points or 1/20%. So because the government is supposed to be risk-free return, okay, you're guaranteed to get your money back, supposedly. If you keep that bond towards maturity, you'll get all your money back plus your 5 basis points. You won't get 4.7-something%, but you'll get your 5 basis points. If you sell it off before maturity, you have to sell it into the market, you get whatever someone's going to pay for it. Nobody's going to pay a lot for something that's paying 1/20% when the market is offering 4.7%. So it's a very steep discount in the price. I can't do the math, but we could do rounded numbers to give you an example. You have 2 bonds at $10 each. They're both paying 10%. So you expect $1 interest by the end of the maturity of the bond for each one. Okay. And then someone offers another bond, and that bond is paying 50%. So in order to get $5 with the $1 bond, with a bond that's yielding $1, you'd have to get 20%. 20% of $5 equals $1. So that $10 bond just got chopped in half, 50% in price. The reason is now the bond yields are equal. But if you pay $10 for the bond and it's $5, you just took a 50% loss. Now the person who bought it is buying it at market rates, is buying it at 20% yield. Did I get that right? But you get the point, right?
Right.
So everything is priced by yield. So in order to get a 50% yield, you would have to basically pay twice what the yield would be. So I made a mistake. So a 50% yield would make that bond $2. Okay, because you're getting $1 in, you're paying $2. A 50% yield on $10 bond would be $5. So if you start off with a 10% yield at $1 and yields go up to 50%, you have to take a dramatic loss. You go from $10 down to $2. That's an 80% loss. I'm sorry. So that's what happened to the banks. Okay, we go from 5 basis points to 4.72% or higher, somewhere around there, and the price of the bonds go down to match that yield. As long as the banks can take their time and wait till the bonds mature, all they lose is opportunity costs on interest or yield. But if they're forced to sell it, they're taking significant losses. Silicon Valley Bank, right? The deals with a lot of Silicon Valley tech companies. There was a draw, a need for cash for crypto companies who have their own turmoil. And then a couple of VCs said there's a lot of volatility and risk and turmoil. I'm not comfortable with the bank security. I suggest you take your money out of the bank. Said this to the portfolio companies. Word gets around, you have a run on a bank, everybody takes their money out. The bank doesn't have the cash. They have to go to their bond portfolio and they sell, but they're selling before maturity. And now they're taking those big discounts. And that's what happened. Now, I got to move forward. Interestingly enough, there is someone who I actually respect a lot. Okay, an entrepreneur who I respect a lot. And he offered to create a bank, a crypto bank, with full 100% reserves. I'm going to pause for a second. Why? Because everybody's expecting me to say he. But the reality is, it's a she. Her name is Caitlin Long. And she said, I want to create a bank named Custodia. And Custodia will be a full reserve crypto bank. And so it can never fail from a run on the bank because it will make its profits and revenues from fees. And we will always have 100% reserve on our balance sheet. Not only did she say that, which is a very strong idea and sounds a whole lot like this she that I know, I'm sorry, he, tall, handsome, brown-skinned fellow, looking like me, and he had an idea for the same thing. Well, he was taken out by the SEC. He would not access to the Fed window, and basically everybody who had any idea along those lines was basically shut out. Okay, she sued the regulatory body who made that decision because they were supposed to make the decision within weeks or months, and instead they took years. And she also warned about systemic risk in the banking system and in cryptos. She was poo-pooed, pushed to the side, denied, and a few weeks later, lo and behold, guess what happens? Run on a bank, right? And you have 3 banks collapse. I heard First Republic was in trouble this morning. I didn't get a chance to look at it, but you had 3 bank failures, 3 bank collapses in just about as many days, maybe 4 days or 5. Interesting. Right? So we don't want the safe bank, but we're cool with the risky banks that don't have the money in cash on hand. The banking model is obviously broken because it can't take true risk. Now, add on to that, I gave warnings. I'm going way past answering your question.
No,
but
you're fine.
let's take it,
Great information. Yeah, please go ahead.
So when I was going over Circle Internet Financial's books, who is the issuer of USDC in partnership with Coinbase, and with full disclosure, I'm bearish on those companies, even though I do not have a bearish financial position on them. Okay, and I have an entity who is suing them for patent infringement. So Coinbase, follow my lead. I'm disclosing. Okay, full disclosure. I say that because Coinbase had disclosed a patent IP suit, which alleges to cover like 90% of their revenue. But I'm going to disclose that I have control of the entity that's suing them for that. Circle's USDC, when I was reviewing it, I looked at their financials and I saw a glaring deficiency in prudent risk management. And that is that they have the USDC reserves on balance sheet, and I don't see how they're bankruptcy remote. Okay, and there's no reason why it should be on balance sheet. Entities come up with very fancy financial engineering and legal engineering ways to put risk off balance sheet. So if you could do that, then you should be able to put the assets off balance sheet, okay, and out of reach. They have things called SVP, special purpose vehicle, SPVs, special purpose vehicles, which are basically entities that exist off balance sheet, that hold assets, and that don't commingle risk and transfer risk to the major entity. So that's where I think it should be done. It wasn't done that way. And Circle has roughly 6 banking partners that they disclose, and they keep about 23 to 25% of the USDC reserves in bank accounts, which they say are segregated. I don't know. I've never seen proof of it, but they say it's segregated. So out of those 6 banking partners, and Circle swears that everything is 100% safe, AAA backing. Okay, it's irrelevant with AAA banking. Circle is a junk rating, so you're only as strong as your weakest link. Think of a chain with a bunch of titanium steel links and one toilet paper link. Right? The chain is not as strong as titanium. It's as strong as the toilet paper. Everything's only as strong as its weakest link. So there have 6 banking partners. 50% of those banking partners went bust in the last 4 days. How safe is that? And because of that, of course, people got nervous. They disclosed it. People started withdrawing and redeeming USDC. USDC broke the peg with $1, broke the buck in Wall Street industry parlance, and was trading as low as 90 cents. Now, when people start to redeem, and not only was it were the banks either put in a receivership or collapse, went out of business, etc., it happened over the weekend. So Circle, I am sure, is forced to start selling treasuries because they likely don't have access to the full amount of cash. Okay. And that cash is only 25, 23, 27%. So I'm sure they're forced to start selling treasuries. And remember how I discussed what happens when you sell treasuries in a rising interest rate market. You don't get all your money back. It's arithmetical. It's mathematical. It's not a discussion. It's not my opinion. It's not even a debate. It's simple math. And on to that.
I'm sorry.
One more thing, and I'll have my plan.
No, you're fine.
Okay. So add on to that. I made this very clear over the last few months and last year. I put out a chart and a model that showed over the past year in 2022 how Circle would have lost money almost every month of the year if they had to sell off those treasuries. And I showed it. I made it very clear the risk would happen. And it looks like a crystal ball, but in reality, it's called a calculator, okay, or a spreadsheet if you're fancy, and it's easy to see. And I said that Circle would not be able, with my legal risk management hat on, I said Circle would not be able to return all their principal unless they use their own capital or outside financing source. Guess what Circle said they do over the weekend or Friday? Take a guess.
They would start selling off their treasuries.
No, but I'm sure they have.
They said they do use their own cash instead of relying on the treasury.
Right. They said they use their own cash for a shortfall. They don't have enough money not to sell the treasuries off, I'm pretty sure, particularly with no access to the stuff in the bank. Okay.
Yeah, Jeremy's kind of misleading his USDC, the people that are using USDC, because you're right, they don't have enough cash to make up that shortfall.
Right, they don't. They had an ongoing concern warning in 2021 when they tried to go public. So even if they did have the cash, it's a horrible business model to give your money to your clients. It's supposed to be the other way around. Okay. And everybody says USDC is a replacement for $1. That's cockamamie. That's the stuff that, comes out the business end of the dog when it's turned around. Okay. And the reason is because if you had $1, you don't have to worry about any of this. If you had $1, you could go and invest it and get a yield on your dollar. If you took USDC and invested it for a yield, and Circle was investing the reserves behind it for a yield, you'll be hypothecating. You're loaning the same amount of principal out twice. That's cheating, lying, etc. Right? Over leveraging. So USDC is not a dollar proxy. It's not a dollar replacement. And it's also very risky relative to $1. Very, very risky. And everything that I said that may happen and would happen has happened over the last 5 days. Every single thing. Not because I'm smart. It's because you look at the balance sheet, use common sense. My daughter's just turned 17 Monday. She figured it out with no problem. So either we need more 17-year-old female CEOs, or maybe people should start going over balance sheets and stop taking a CEO's word for something.
Well, and maybe we might need more dads that are willing to invest in their daughter's education and spend time with them, teaching them like you too.
Thank
you. What you were just talking about with the dollar being invested twice, that reminds me of the fractional reserve banking that that I learned about when I went down the rabbit hole and learned about our legacy financial system. Are you saying that that Circle or Coinbase is doing a form of fractional reserve banking with their dollars?
They're not. I actually thought they were at one point. I thought Coinbase was, but I was mistaken, and I apologize. Like a person does. Not only do I make mistakes, I make them a lot. I made a mistake in April of 1999. Actually, that's a joke. I did make a mistake back then, but I've actually made a mistake since then too. So I'm in comedian mode today. So the difference, the reason is Coinbase went to MakerDAO, and this is another interesting story, which I warned everybody about. They went to MakerDAO and convinced MakerDAO in one of their MakerDAO proposals to give them $1.6 billion of USDC, and they would give them a yield on the USDC that they put on the Coinbase platform. Usually when you give somebody capital and they offer a yield for that capital, they're usually taking a risk for that capital, probably lending it out. That's where the yield comes from. That's what I assumed. Even though I made a mistake, it was a very valid mistake, valid assumption. What they did was Coinbase is Circle's distribution partner, marketing partner for USDC. And there's a yield that's had on USDC when they invest the money that you give them in treasuries, commercial paper, etc. Coinbase is sharing the yield that they generate with their customers and clients. Now, it was a mistake that I made, but there's still a problem. It's still negative. It just wasn't negative the way I thought. Number one, do you or Trey own any USDC? Or do you have any?
No.
Reggie, I got rid of all the USDC that I was managing when I read your report. I mean, I was paying attention.
Just in time. Okay.
Yeah.
So when you had USDC, how much did it yield? How much did you give you in profits or yield or interest?
I think it was yielding between 3 and 5%, somewhere in there.
Okay. And where did you keep it, if you don't mind me asking? It's none of my business say so.
I kept it on the Polygon chain at Firebird.finance.
Okay. So the USDC was being invested in something else, correct?
Yeah, that's right.
Okay. So that's how the yield came about. And that's what I thought Coinbase was doing. When you take USDC and you invest it to get a yield, okay, and then the investments that Circle is making, if they were to go bad or if someone has to pull that back, right, you could only get 100% of your principal back. Okay. But you lent out 200% of debt. So that is that's fractional lending. Okay. It is rehypothecation. It's basically taking $1, lending it out 2 times. The double spend, as in the Bitcoin blockchain, and it's a no-no. That's why you cannot safely lend out USDC, because it's already encumbered by debt already, by Circle. How much does Circle pay you for the risk that they're taking in investing it, and the risk of Circle being a junk-rated company? I'm pretty sure it is, and getting ongoing concern warnings, and the regulatory risk that Circle has, and the operational risk, and the risk of regulatory pushback. How much is Circle compensating you for it? Let me try to do the math while you're thinking. Zero.
Nothing. Yeah.
Okay.
You're taking all the risk.
Right. You're taking all the risk. Circle is getting all the return. They're splitting it with Coinbase because Coinbase is good at marketing, and they're sharing it. Coinbase said, I'm going to give you a little bit of this return back if you bring your $1.6 billion of USDC onto our centralized platform. Okay. So you're taking return-free risk with USDC anyway, not risk-free return, return-free risk, right? Lots of risk, you're not getting any payment for it. And then I made a video warning about return-free risk. I made a video warning about USDC. I also did a video warning after dropping my daughter off to school. I'm not dropping her off. She's a senior about to go to college, but, I'm that type of dad.
You got to go with her, yes.
Yeah, she's pushing me away like, Dad, please. So I was walking across the High Line, which is a little elevated park, right, in Chelsea. And I was warning that it was foolish for MakerDAO, and for those who don't know, MakerDAO is a decentralized stable currency platform, algorithmic. And its whole purpose is to create a stable coin that lives on the blockchain organically and inherently on the blockchain. So it's decentralized, or much more decentralized than other stable coins. And they accumulated roughly 35 to 36% of their reserves in, guess what? USDC, which is purely centralized, regulated, and all the other things that make a DAO was aspiring not to be. So decentralization is something like the color white, okay? It is impossible to mix it with something else and have it still be white. So with decentralization, it's impossible to mix it with anything besides decentralization and have it still be decentralized. That doesn't mean it's bad. Like, you could mix red and white. It doesn't mean you have a bad color. You might like pink, but one thing's for sure, it's no longer white. As a matter of fact, anything you mix white with besides white makes it no longer white. Anything you mix decentralization with besides decentralization means it's no longer decentralized. So taking a decentralized product or decentralized protocol, allegedly decentralized, and then backing it with USDC defeats the entire purpose of decentralization. Number one. Get the camera. That's issue number one. I also brought up issue number two. If you're going to use a decentralized, if you're going to use a centralized reserve asset, okay, or investment, and remember, USDC is not an investment because it gives no return for the risk you take. It's a return-free risk. If you're going to use something centralized, make sure it has an ample risk-return ratio, which meant you want to buy 2 units of risk for 2 units of reward for 1 unit of risk. Economically, that is a 50% return, 100% return, 50%, 100%. I'm sorry, 100% return. So let's assume risk costs you $100, but you pay $100 to get $200 back. $200 is the reward, $100 is the risk. You subtract the risk from the reward, and you have $100 left. That's a 100% return. Now, you may never ever have to pay that reward economically, realistically. It's like running across a highway with a blindfold on. It's quite possible you could get to the other side. But if you do it 100 times, the chances you won't get hit at all 100 times is close to 0. So the more times you do things, the more likely a statistical probability will occur. And that's the way it works. So they decided, Coinbase, with a very significant tranche of governance tokens, and Coinbase's partners, such as VC firms who invested in both Coinbase and MakerDAO, exchanges, etc., voted in favor of this. Coinbase might have abstained, I have no idea, but somehow they got the vote to get $1.6 billion USDC put on Coinbase's account. Okay, and Coinbase said, we'll share some of the return for the risk that you're taking. So fast forward to today. I remember I did that, I think, in the fall. Okay, somewhere around October. Yeah, October. Okay, so you fast forward basically 6 months, and guess what happens? Guess who was right? Well, Circle's having very big issues, and their banking partners are falling, collapsing, locking up their capital, and all types of things are happening. MakerDAO has emergency proposals now to minimize its exposure to USDC and to prevent people from pulling USDC out quickly, okay, which would cause much more of a problem with their very delicate system of managing collateral. They're trying to mollify a problem that they solely created. And I told them, I'm not bragging. There's so many things I do. I told you I made a mistake in '99, and I made a lot of mistakes since then. You know, and probably made a mistake this morning, and I could be making a mistake right now, even saying that. I make a lot of mistakes. But, you know, when I do something right, I also do things right. I told them that was a mistake, and it was an obvious mistake. You know, that's something you can see coming and avoid. They chose not to. So now they're trying to fix a problem that they caused themselves. Okay, and that problem is a serious problem. I'll land my plane there. I did a lot of talking, but I covered several things. So
yeah, you definitely did. So we're looking at Signature, Silvergate, Silicon Valley Bank were the first to fail. And why do you think that it seems like they're trying to blame this on crypto or having these bank failures? We know when you were teaching us about the Masada, or the term that you coined, that money is a depreciating asset, and how that plays into. I'm hearing you talk about the bonds as you were explaining that, and how that's all connected. We're watching the Fed, the FDIC, and the Treasury partner to make this promise to make everyone whole. Can you explain that or break that down for us? How that partnership, is that even possible to do what they're promising? And do you think they are trying to blame this on cryptocurrency? Would that be akin to trying to keep people from running to something like gold or silver that people would have freedom to have in their own possession, like back in the 30s?
Okay. Well, that was a compounded question nested in a question with a compound on top of it. So I'm going to answer like the first one and two, because if I can remember it, and then ask me the other one so I could,
Okay. We'll unpack it together.
Okay. So first of all, they're blaming the bank collapse on crypto, and for the first time, I'm going to agree with them. It is crypto's fault, because those crypto companies put their money in that bank. Okay, so
they should have kept it in crypto. They should have stayed decentralized.
Yeah, you put that money in the bank, and the bank was, even though it was regulated, had liquidity minimums, FDIC insured, etc. That bank, right? Those banks, over a 4 or 5 day period, 3 banks went bust. Okay, and they captured those crypto companies' money. Now, I'm going to contrast this, because I've been called a lot of names myself, which I didn't think were appropriate. I'm going to contrast this with an alleged fraud, an alleged Ponzi scheme, an entity that was attacked by attorney generals, sued, etc. Tether, and I'm not advocating for Tether. I'm not recommending them. I'm just recounting fact as I see it. Okay. Tether was accused of all these things, not having backing for their Tether tokens, which is a stablecoin matching a $1 US dollar for 1 Tether, for those who don't know. During the Luna Terra fiasco, where they made an algorithmic coin, it just didn't work. It was broken. It seemed obviously broken to me from the get-go, but apparently somebody fell for it. They had significant redemptions. If I'm not mistaken, they had more redemption calls, or larger redemption call in aggregate, than 1 or 2 or probably all 3 of these banks. Tether met each and every dollar, as I understand it, and Tether's still humming along. The so-called fraud, this, that, and the other. Why is that? Well, because Tether allegedly backs each dollar with $1 of reserve assets. These other companies do not, and they do it out in the open. And so when someone wants their money back, and they want less money than Tether offered, these banks collapse. Voila.
Well, I can add to that. Do Kwon, who ran Luna, also had 80,000 Bitcoins in reserve that he was selling on the way down to prevent the collapse. It ended up not being able to prevent the collapse, but there was a little bit more than just Tether behind the Luna collapse that allowed them to meet their redemptions.
Okay, well, you mean allowed Tether meet that redemption?
Right. It wasn't stressing Tether 100%. There were 80,000 Bitcoins that kind of softened the blow on the way down.
Well, soften the blow of the Luna collapse, you mean?
Yeah.
Okay, but regardless of that, I'm talking just in terms of redemptions. Everybody who went to Tether
made its redemptions. It did.
Yeah. Everybody who asked Tether for their money back, they got it back, and Tether is still humming along. As a matter of fact, now they're humming along. Tether is the largest stablecoin provider by at least 100%. So I think they're at 70 or 80. And USDC was at 40 something, and now they're probably down in the high 30s. I'm pretty sure they're getting a lot of redemptions. So, and I'm not advocating for Tether. I have nothing for them or against them, right? I still believe the whole stablecoin model, as it's currently run, has a perverse incentive where they convince people to give them money and they make money off of it. And the people who give them money get nothing in return. It's like getting $1 that you can't lend out. Okay. That has credit and counterparty risk attached to it. So with that being said, somehow Tether did what these three banks who are FDIC insured, state banking charters, state regulated, government regulated with liquidity minimums and statutory capital requirements all collapsed in a few days during stress. And less stress than Tether had, if I'm not mistaken, after I haven't done the counting. So let's put that in perspective. From the way recent history shows, stablecoins are a better business model of fractional reserve banking. But nobody wants to hear that. And stablecoins are a broken, perverse business model. And if that's better than the fractional reserve system, then, it's time to start looking at the fractional reserve system. So long story short, yes, crypto is responsible because they put their money in insolvent banks. So the people who say crypto is responsible probably don't want to hear the reason. You probably don't, but that's it. Okay.
Because they duplicated the legacy financial system that Satoshi was trying to give us an opportunity to break away from.
Mm-hmm.
So I wanted to ask you about also the Fed, the FDIC, and the Treasury are breaking away from what we've heard for years, the $250,000 insured model or limit, and saying that they're going to make all depositors completely whole without raising taxes in this partnership. Is this even possible? And what will this do to the US dollar and our economy?
Well, I didn't read their proposal, personally. So I'm going to go for what I've heard from, what you just said in social media, et cetera. I did hear that they set up a lending program where they will allow deposits to be lent against at par, pending getting the money back from the bank. That's what I heard. I have no idea if that's true because I didn't read it myself.
Okay.
I've been doing a lot of lawyer stuff today. But on my few minutes of peace and my peaceful ride to bring my daughter to school, we did discuss this. And she said that, they're going to make these three banks whole. She says, isn't that good? And I'm like, I don't know. Let's test the sustainability of it. So Silicon Valley Bank is the second largest bankruptcy in the history of this country in terms of banks, with the largest one being Washington Mutual, with just a few $1 billion more, by the way. And three banks went bust over the last 4 days or so, 4 or 5 days. And so I Googled how many banks were there in the U.S. And they didn't give me all the banks in the U.S., but they did give me the FDIC insured banks. And I think it was 4,627 banks. So I said, so they bailed out all the depositors of these three banks, and they only have 4,624 more banks to go. How's that sound for sustainability?
Yeah, when does it end?
Well, it's going to end before they get to 4,623. I can tell you that much, because the system wasn't designed to bail out all profit at risk. Now, I was also on a social media thing on Clubhouse this morning, and they were discussing it, and they were saying they're just bailing all the banks out, but they're not bailing out. They're wiping out the shareholders. They're wiping out the bondholders. So they're making all the investors take the first hit, okay, and the second hit. But the problem is, when you bail out the depositors, you create profit at risk taking. If I know I'm going to get my money back, then I'm not going to bother to vet the bank. I'll just give it to any bank. And then it's no longer a business. Okay, so people have to take losses for bad decisions. It's just that simple. That's what a business is. If you don't want to take losses for bad decisions, don't expect reward for good decisions. Okay. Now, moving forward, she was like, how about the big banks? And I said, well, the big banks like JP Morgan are safe.
Okay.
And she was like, why? I'm like, because. And then before I went to answer, we went through, another Google thing. And I warned all my kids about Google, because that generation, my kids range from 17 to almost 31. And they will go to Google, ask Google a question, get the first result. Here, fact. No, here first Google search, right? Who who created the content that came up first? How much did they pay for it? Right? What agenda do they have? Is it accurate, et cetera, et cetera? But that's another lesson for another day and my, irritating fathering style. Okay. So so
because on the JP Morgan thing, I agree with you. This morning, they were just all the talking heads were it's, when it's like when they're all getting the same script. Hey, you're supposed to say this, you're supposed to say this. And they were all talking, oh, well, as soon as I get my deposit, I'm going to go, straight to JP Morgan Chase and open and where I'll be safe. I'll be safe at JP Morgan. But I looked at your Twitter, almost daily and make sure. And I noticed your terrible, horrible report about, not your terrible, horrible report. I'm sorry. JP Morgan's terrible, horrible quarters, Q2 of 2020. And so could this have been a calculated effort to make JP Morgan whole on from them actually struggling?
I wouldn't go that far, but I would explain.
I'm a little bit of a conspiracy theorist. So,
oh yeah, I don't know if it's a conspiracy or not. It could be. I don't put. After my experience with the government, there's not a lot I'll put past them. Okay. But this is why JP Morgan is safe. And I told my daughter, I said, I think there are 127 countries in the world. That's what I told her. So I said, Google it. She Googled it. It came out to 195, with 193 being members of the UN or United Nations, I think, and 2 observing countries. One was the open sea country, I think, and the other one was the nation of Palestine. Okay, and all the others were a member. All other countries were a member. 193 members, so 195 altogether. So there are 195 countries in the world. Okay, I told her, now ask Google to list those countries by GDP. She did. We had the first by listing it by GDP, right? And then I said, let's Google what the asset size of JP Morgan's balance sheet is. JP Morgan has $3.6 trillion of assets on its balance sheet. That puts it in combination for sixth place, combating for 5th place with the UK. So you have the United States, China, Japan, Germany, UK, and JP Morgan.
Wow.
JP Morgan is either the 5th or 6th largest country in the world by balance sheet as a proxy for GDP. So if JP Morgan were to go bust, think about what that do to the world. Think about the 190 countries below JP Morgan. Think about what it do to the US economy. So JP Morgan is safe. You know why it's safe? Because it's too dangerous for it not to be safe. Too large to fail. Remember in 2009 when they came up with the Dodd-Frank Act and to get rid of too large to fail? Look at JP Morgan's asset size, balance sheet size in 2007 before they started doing that. So they fixed too large to fail by making JP Morgan too larger to failer.
And that's where we always pay for it.
Yeah. So there's no way in the world this country can allow for JP Morgan to fail. It'll drag the country right down with it, as well as Western civilization's finance. Japan, UK, Europe, and China.
Hey, Reggie, we're running into a hard break for you. It's 6:00 Eastern time right now. Do you have a minute to field another question, or should we break here?
Let's go 5 minutes more, then we'll continue this at another time.
Okay. You want me to jump in with a question?
Yeah. You go ahead, and then I'll save my other little treasures for another day.
So, not many people know this because not many people dig into the Fed balance sheet like I do. But the Fed has $1.3 trillion of unrealized losses from last year that they haven't pulled forward on their balance sheet. The Fed is in the business of lending money to the government and making sure the economy ticks on. They seem to be stuck in a pickle right now where inflation is causing them to lose tremendous amounts of money. But if they tackle the inflation side of it, they seem to destroy the dollar. Are we in a death spiral for the economy right now? And if so, what's the solution?
I think tackling inflation doesn't destroy the dollar. It destroys dollar-denominated investments if they raise the rates too quickly. So it's a little nuanced. At the end of the day, they're destroying dollar-based investments, which makes, the dollar harder to buy. But, the dollar is in a very unique situation where there's nothing to replace it. And the reason why it's the reserve currency is because the U.S. backs it. And we've had this discussion several times in different venues. I think we've done it here as well, where I asked people what the global reserve currency was and how do you attain that status. And just to jump to the end, you attain the status by blowing up anybody who challenges it. And so because it's the truth, right?
Yeah.
And because there's nobody who could challenge the U.S. militaristically, technologically, economically, or geopolitically, it's the reserve currency. And if someone challenges it, if they can survive that challenge, then they're the reserve currency. Nobody's survived it yet. If you think that this is outrageous or a little bodacious, just think back in the history. The reserve currency before the US dollar was the British pound, right? The pound sterling. They called it pound sterling because 1 pound sterling, 1 unit, the British version of the dollar, used to actually buy a pound of sterling silver. Right now, it'll buy probably 1/600th of a pound.
Something like that.
I'm trying to do the math. A kilogram is about $800 right now of silver, and the pound is a tad bit under $1, I think. So do the math. Yeah, do math too much, man. But it buys a whole lot less than a pound. Okay, a small fraction of a pound. Yeah. So, but more importantly is the British pound sterling was a global reserve currency for a very long time. Why is that? Because they blew up anybody who said it wasn't.
Yep.
And Britain is probably the most imperialistic nation in the world, except for one of its child colonies, which is America, which probably took the British Empire's record. But that, they have that in common. Go all the way back to, the drachma and Rome. Same difference. Why did Rome have the reserve currency? They couldn't blow everybody up. They just stabbed and pillaged and raped everybody who disagreed with them. So that's how you make the global reserve. So it takes, a lot of people think in terms of debt, etc. It doesn't matter how much debt the global reserve currency holder takes on. They extinguish the debt by blowing up whoever they owe money to, whether it's militaristically with bombs, whether it's geopolitically, whether it's financially, whether it's through worms and malware and a variety of other things, sanctions. And no imperialistic entity survives in perpetuity. You get too big, you fall over, someone takes your place. It's not US, there's not the US time yet. So that's a method of looking at currency and debt that you're not going to learn in business school or your global macro class or in law school. But trust me, it works when you stress test it against the facts and history.
That's
fantastic answer.
A great history lesson for us here. I know there's so much more to talk about. I hope you'll come back this week and let us talk more about the anticipated CBDC rollout that we think is going to be coupled with this contagion that we expect more to come out, as well as them halting trading on Wall Street and lots more ahead. So thanks so much for your time.
Let me make one comment in leaving.
Yes, please.
Assuming CBDCs were rolled out already, and then you had a bank run, instantly solved.
Yep.
See, you ever run on a bank? No, you're not. Bye. No more bank run. You want to run with the money, but we just electronically limited your wallet to 45,000 withdrawals. So there's a tweet that came out that had VC Karens, and they said the reason why the government decided to backstop all depositors in Silicon Valley Bank versus up to the $250,000 limit is because the VC Karens, with the Karen being the derogatory slang term, the VC Karens ran up to the government and said, "I'd like to speak to your manager." So
this could have been a dry run for the real bank run next week after they roll out FedNow, anticipated on 3/20.
well, we'll see.
We'll see.
I've been kicked out of the banking system, so I'm not a big relier on the banking system. So more power to you guys who believe in it. You know,
might be the safest one here. All right. Well, we're going to talk about this and solutions.
When we come back, we'd love to talk to you about solutions where the Veritaseum intellectual property fits in to the solution. And, my vote is that we get you and Caitlin in on a government committee and teach them how to run a successful economy. I think.
Oh, yeah. Look at Caitlin and look at me. Just look at us. Use your imagination.
Would obviously be the mouthpiece. You would be the brains. Y'all two can get some ideas together to help these guys out.
She's smarter than me, so I think maybe she'll be the brains and the mouthpiece too. But if you look at Caitlin, you look at me, and then you look at all the meetings you see and all the people who run this, and the crypto companies who flourish, and the banking executives who do get the licenses that Caitlin went after. And here's a fun fact. I went after a cryptocurrency BD brokerage license back in 2017-18. And I got a Wells notice. So,
wow.
If you look at the guys who do get this, they don't look, sound, or act like Caitlin or Reggie.
Yeah.
Just to know.
They all seem to be white males.
And let's forget white males, even though that seems to be accurate. But we push that out the way. If you look at their ideologies. Shout out to Caitlin, because you were absolutely right. They turned down a full reserve bank and let a fractional reserve lending bank collapse, and then another one collapse, and a third one collapse in 4 days. In 4 days,
making her look awful good right now. I mean, the tweets that she's put out and her LinkedIn posts are phenomenal.
That is true. So shout out, props go out to Caitlin. Sorry.
The truth is hard to hide. When it comes out this strong. Well, thank you so much for joining us. We will see you guys again. Make sure you like and share this video. Let's get more of the truth out there, and follow Reggie on Twitter. He is on top of it. Thanks, everyone.